What's going on, everybody? It's David Piatek with Lourdes Fernando with VA Housing Education. Today, we're talking about being credit savvy, understanding credit, and really the impact that it has, because it's probably the most important part in a transaction outside your income, right? We have a lot of veterans out there that are like, I am eligible for my VA home loan. Why can't I use it? And it's simple, right? There's two parts to using your VA home loan. The first one is eligibility. Do you meet the time and service and character of discharge? Now, most of you out there meet that criteria. It's the qualification piece that a lot of veterans get stuck on, right? It's the credit, the income, the hey, do you have savings to make your payments if in the event our loss happens, or you lose your job or something like crazy like that, or if you need to do some repairs to the property. All those things are a major factor in getting a VA home loan. Now, we're going to talk about three main things today, and I want you guys to drop questions as you have them. We'll try to get to everyone. The important one to start off is understanding credit scores and the impact that they have on you. The other part we're going to talk about is how to build and maintain credit, which is something that, a lot of people struggle with. And then we're going to talk about how what credit score do you need to actually use the VA home loan? Because this one is kind of it's tricky because it varies. And we're going to talk about why those things happen, right? My experience is in the lending. I have a lending background. I've served in the military. I still serve in the military in the Guard for the last 14 years. So, and I work with a lot of military members across the country or across the globe, actually, that are PCSing. Lourdes has firsthand, not only a veteran herself, former veteran spouse, so she's kind of had both of those, plus PCSing across the country, getting bad information on VA home loans. That's kind of how we met, right? This was like 5 years ago or something like that. You were moved here. You're like, David, I don't know about this. And here we are today, collaborating together to be able to educate the veteran community around using the VA home loan and really how it works. So I'll let you kind of kick it off, Lourdes, and really understanding the first part of the credit scores and the impact that it has.
Oh man. So yeah, credit does have a huge impact. And this is something even before I got into the profession, I was like, oh, always have that good credit, have that good credit. But why? And it comes into play. And I want to say the biggest thing is it determines your interest rate and then also your eligibility. People can have the VA home loan and can't use it because of their credit. So as you said, making sure that you hit all the requirements, because there's multiple requirements, not just one. Or you can have stellar credit, but you don't have the income to support it. So they look at your overall picture. And that's one of the things that you can work on. You can't control most of your things, but your credit's one of those things that you can control. And it just proves to lenders that you are responsible enough to make your payments. So if they start to see a lot of things on your credit, like late payments, and if you have $10,000 on a credit card and you're using 10,000 of that, they're going to say, oh, wow, like this is probably not going to be the best candidate. So that's one of the things that you do have to watch. And that's what we're here to do. And I know I reached out to David when I had a goal. I was like, I want to own a multi-unit. That is my goal. And nothing's going to stop me from getting there. And it was a struggle, let me tell you. But I was able to reach out to David and say, hey, I even called him when I went to go buy a car, and I was like, hey, David, what do I do? How do I do this? What is my budget on monthly payments? Because I didn't want anything to affect my property, and I needed a new car. So that was one of the things. I had a 4-wheel, it was sliding in the snow. I needed something. So that's something that I called him out. So definitely reach out to the professionals on that, and one of the things too is it took me 3 years to get my building, and definitely reach out to people like David. He can help you. He can guide you on the right path and how to get to a place where your credit is going to be in line for the loan.
Right. Now, and that's time, right? I mean, that's just kind of like, so, I want to also let everybody know out there is that for some people, home ownership is right away, right? You come in, you're eligible, and you're able to use the VA home loan with qualification. For others, life events happen, and there's nothing wrong with that, right? A lot of things can happen in life that can derail that dream. But remember, it's only temporary, because at some point that is going to shift and you're going to be able to do it. So yes, sometimes it may seem discouraging, but at the end of the day, it's 100% possible. And we're going to talk about some of those ways today.
Yeah. And definitely, it's and like I said, it's important that you understand that if one lender can't work with your credit, there might be another lender that can. So it's not and a question that you can ask, is this a bank specific requirement, or is this a VA requirement? And that's very, very important, because we've had, they're disqualified with one particular lender and they can go with another. So when you're getting ready to sit down and look at that, definitely ask those questions. Is this a VA requirement, or is this a lender specific requirement?
Oh,
So
yes.
you may need to shop around a little bit, but David, I did want to ask you a question. What are the best ways someone can check their credit, and does it affect their credit score when they check?
We get that all the time, but I want to answer a quick question here from VA Disability Night Off. Thank you for a shout out for the great information. So he had a good question. Is that for credit and VA loans, do you necessarily need multiple credit cards, or can one credit card be good enough being utilized at 15% or less? I'm going to answer that right now. So the piece to that is that when you think about credit, it's the time and length that you've also had that, right? So the longer that you have credit and the more credit you have, the easier it is for a lender to determine, like, oh, they've been able to maintain 3 or 4 credit cards, utilize them sparingly, and then pay them off on a monthly basis, is going to have a greater impact than just having one credit card that you've utilized at a low percentage. There's just not enough credit, right? Just think about it. It's like being in the military. If you just pass through basic training and never advance through, you're most likely not getting promoted. So it's kind of like the similar piece here, right? The more that you have, don't get crazy, right? We're just saying like 3, 4 credit cards, like that makes sense to be able to get. And then we're going to touch on that actually when we talk about building credit. But Lourdes, to your question, what's the best way that someone could check their credit score, right? So let's talk about a couple different ways. There's 2 types of credit inquiries. There's soft credit inquiries and hard credit inquiries, right? Soft credit inquiries are like things that you get from your bank statement, your credit card. If you go to Credit Karma, right? All of those are free credit reports, and they're soft credit inquiries, and they don't always pull everything. Then you have card credit inquiries, where actually like a lender will actually pull your credit report for the purposes of obtaining credit. That's the difference between a soft pull and a hard pull. One is a consumer is requesting information for their own information. A hard pull is a lender is requiring to look at your credit to determine if you're credit worthy to get a product, whatever it may be. And remember, credit has an impact both on your car insurance, car loans, pretty much any type of insurance that you need, life insurance. They'll look at your credit, your health. They look at everything. So just again, these are all things that they're gonna come up. And then you have things like Vantage Score, which is pretty much what everyone uses. Lenders use a specific FICO score, okay? And it has a wide range. It goes up to 850. I don't even remember what's the lowest, because we never really see the lowest, right? Yes, sometimes people have credit in the 500, but again, all of that you can utilize or you can get out of to rebuild that. All of that just kind of takes a little bit of time to do that. The other big difference between, let's say, a Vantage score and a FICO score from a lender, sometimes we're going to see large swings in the credit scores themselves, right? So someone may have a 780 on a Vantage score, and then we pull a FICO and it's like a 660, because they look at different factors into the loan. With Vantage score, they give you better credit with less credit. So it's sometimes deceiving, because then when you go to apply for a loan, you don't have that same credit score. but the vice versa may be the same. You may have a really good FICO score, but not a good TransUnion score. We've kind of seen it all. So the thing is that the best thing I could recommend is talk with a lender, no matter how early in the process it is. It helps you determine where you want to be because you're making life decisions from all of this. Now, the way the score itself is calculated is based on a couple of factors. One of them is going to be your payment history, how you utilize credit. Lourdes made a good example. We see it a lot. $10,000 credit limit and you're maxed out at $10,000. Huge impact on credit. So like when we look at someone's credit score, we'll see it. It'll say like, oh, it'll say 660, 662, and like a 640. And then next to it, it'll say plus 81, plus 65, plus 72. And that's because if you pay off your debt, your credit turns around and goes into the high 700s, which Lourdes mentioned earlier, you get better financing terms, right? So the people with the best credit, not income, the people with the best credit have the cheapest money that's available, and they get the best financing terms, and they pay the least amount of interest. So again, those are things that are going to be factored in. The length of credit is a big one. How long you've maintained credit, right? The longer you've known someone, the more you trust them, right? This is just like life. So this same thing applies with credit. Having new credit inquiries, that doesn't really have much of an impact. When you look at Vantage Score, it tracks a 2-year history, but in real financing world, they only look at the last 60 days to see if you took out new credit, okay? And the type of credit you have, credit cards, installment loans, mortgage, all of that help in diversifying what your credit mix is going to look like. Now, Lourdes, you asked, what impact does it have when you have a credit inquiry? Well, with mortgages, you have a 45-day window to shop for a mortgage lender without having an effect on your credit. Yes, when you have the initial credit pull, there's going to be a couple points that it's going to drop, and that's pretty much it. And then it's going to stay there. Anything over 740, there is no difference in pricing. So you could be at 850 at the absolute max. You'll have nothing different than a 740, but you want to get it checked because, again, we talk to people across the country that tune into our YouTube channel, and they'll be like, hey, I'm looking in a year. This is kind of my situation. Almost every time I'm like, listen, the best thing to do, let's check. So when you're making these life decisions, especially you're PCSing across the country, because you're talking about it, right? Like when Lourdes, you're buying a home, you're letting people know, hey, I'm buying a home. It's exciting, right? Same thing with me. I'm buying a place. I'm letting people know, like, yes, it's exciting. We're buying a place. So all those things have, an impact on you. So, Lourdes, have you come across people that have had their credit changed or like been denied for a loan after they've been pre-approved for a mortgage?
Yes, David. Unfortunately, yes. So as a real estate agent, we want to make sure that we are asking our clients, not to pull any new lines of credit, not to buy any cars, not to do anything. And if, there's been emergencies. Okay. So like I said, I was in the running to purchase a car, but just make sure that run across your lender and say, what is a max payment that I can do to still keep my qualification? So we get it. Stuff happens, but just be very transparent with your lender. Do not, and you can literally go the next day after you close, or even the day of closing. We've had a client that went the day of closing and went to go buy a car. So you can totally do that after. Just make sure it's in your plan. And if you're really, really close to your max budget and you do any of these things, we even had people spend their closing costs money to buy furniture before they were going to close, and then they can't even afford to close. So there's been so many instances where yes, they don't qualify because something has changed in their financial picture. So it's very, very important that you are transparent with your lender. Some lenders check in with their clients and others don't. So it's very important for you to work with a team that is going to be checking in and don't feel I had a client say like, "Oh, well, my lender doesn't like me asking a lot of questions." And this is the time then you might need a new lender because you need to ask these questions. Don't do anything that can change your financial snapshot because you can get that denial. We've and thankfully it hasn't been many. We've had a few situations where we couldn't close because once again they bought a car or they spent their money for closing costs and or they opened up some new credit. So that's something that is crazy. But yeah, do you have any
Yeah.
insight on that, David?
Yeah, I think listen, like you mentioned, is that there's definitely times where if somebody is even changing jobs in the middle of buying a home, that's okay too. Listen, all of that is okay. It's just you have to understand the impact that it has on finances. I think the common thing that people think, and I understand where this frustration comes from this following statement, is that when people say, "Oh, this should be common sense." Remember, don't think that word when you're buying a house because you're going to have to give a lot of information, and what a lender and a financial institution look at is going to be different than what you look at a day-to-day basis. We even help financial advisors that know finance but they don't know lending, right? When they're like, the best clients are oftentimes finance people because they're like, I don't know what I'm doing, just tell me what I got to do and I'll do it, right? As long as you're comfortable with the budget, which is critical, the rest of it kind of falls in, right? So let's talk about building and maintaining credit, right? There's three. Well, let me tell you this. Credit is something you control, nobody else, unless you get your identity stolen. That's the only time you can't control credit. No one sits there. I don't sit there here telling you on YouTube, you need to open a credit card and max it out right now and then stop paying the bill. I don't say that, right? It's responsible credit, right? That's where credit scores come from. It's how you spend money, it's how you take out money. Life events happen. How do you control life events? You can't. But what can you control? Your budget, how you spend money, how you save money. I feel like I'm starting to sound like Tony Robbins, but it's just like you have to take control of that, right? The three major players around credit are you going to be Experian, Equifax, and TransUnion. Want to touch base on one thing you said earlier, Lourdes. How do you get a full credit report? Go to free credit report or free, I think it's a free annual credit report.com. Let me just confirm that. Is that what it is? Free annual.
I use your favorite site, Credit Karma.
Yeah, you can use Credit Karma. Yeah, so you go to annualcreditreport.com. And then basically every year you get a full credit report for free, right? So you go to annualcreditreport.com and you can get it annually, but you do want to monitor it on a monthly basis, right?
Oh,
That is super critical, right? Do not and stop believing in auto pay. Like, yes, auto pay is great, but you need to follow up 2 days after auto pay to make sure there's no snags. I've seen it too many times where money doesn't get pulled. Now you have a late. Now you're like, well, remember, it takes a lifetime to build credit, and it takes one event to derail that whole piece, at least for a little bit of while, right? The major thing around credit is going to be how you make your on-time payments and how you utilize credit. That's pretty much the basics of it, right? I mean, if you get a credit limit for $10,000, but you make $4,000 a month, that's dangerous because if you max out that $10,000, it is extremely hard to pay that money back. But there's definitely ways that you can do that. It's just sometimes takes consolidation loans, which are expensive, and we've seen people with them, right? But it's not a big deal. You just have to be able to tap into that piece. Now, if you don't have credit, that is okay too, right? You're gonna have to start off with starter credit cards. A lot of times you have these college credit cards. I know Capital One is really good with, and Discover Card is good with new accounts. Like, hey, I'm just building my credit. They're really great with that. You're not going to get a big credit line, but over time, those credit lines are going to increase. And again, you're going to go from 2 credit cards to 3 or 4, maybe. And remember, good credit cards, there's like 0% interest for 21 months. I mean, like that, if you need to do a home improvement project, hey, something happened with the car.
mhm.
Remember, credit is not driven by your income. It's driven on how you control your expenses, which is an important part to that entire piece.
Yeah, definitely. That's a really good point, David. It's so crazy. We buy everything with credit cards. Like today, I went to open up an account, and they're like, "Do you want a debit card?" I'm like, "A debit card? No, like I want my points." So I'm using credit cards. But it's very important for you to definitely, like how you said, pay it off. Know the threshold of what's going to affect your credit. If anything over that, what, 20%, it starts to affect you, and that's 20% of the utilization. But really going into the specifics and seeing what that is. And a lot of don't really say like, hey, Credit Karma is like the best, but it will teach you, it will show you where you need to stay and like what's affecting your credit, and if I pay this off, how is that going to increase my credit. So I think that's very, very important. David, how do you get back on track? I know and I'll be the first to say, I think I purchased a class and put all of it on my credit, and there was 4 or 5 different credit cards that I used, and I maxed all of them out. If that's the case, how do you get back on track, David?
So this part is everyone's situation is like a snowflake. Okay. It is definitely going to be tailored to each individual person. And it's hard sometimes to look in to face the facts because I've been there as well before. Right. So the thing that you first have to do is you have to create a budget, and you need you may disagree with me on this, Loris, but I'm a fan of Excel sheets. Don't like people are like, I'm going to link all my apps, all my credit cards and everything, but that doesn't, you're not looking at your state. Like you need to physically pull them every month and let the pain sink in, right? If you're paying 27% interest, and guess what? If you missed a payment, you're paying like 50% in APR on these credit cards. It's okay. Take a hold of your financial situation, grab it, and it's like throwing a grenade for the first time. I remember the first time throwing a grenade, I was scared. But like once you do it, you're like, you know what? It's not that bad. But I know what the repercussions are of all this. Pull it. Pull your statement, right? That's why you itemize all your debt. You itemize how much the balances are, what the payments are, what's the debt interest rate on these, and then you come up with a strategy based on how much I make, based on me controlling my expenses. How much can I put away at each of these, right? Or you might be at a point where you can consolidate them with like an interest-free credit card. That's even better. Just don't relapse, right? That's the challenge I think Lourdes people face, is that they will work on their credit and then there's like a relapse event, right? And sometimes, it's the people you're around that spend money. I mean, sometimes I don't even go out that much. I maybe go out once a week on a Friday with my wife for like a date night. We like order pizza. Like that's our special event, right? Otherwise, we're cooking at home, we're budgeting, and it's not fun. I'm sure you just say, it's not exciting to be like, we're not trying the fanciest restaurants where, when I go out, I'll see people drop $200-300 a person. And I'm like, that's how, yeah, but you see those credit cards, they're getting maxed out. And then we see it. And then like, I can't buy a home. Remember, $700 car payment a month, $700 is $100,000 in purchasing power. $700, $100,000 in purchasing power, right? So that's why, Loris, when you call me, like when you were at the dealership, that made a big impact for what you want to do. Do I pay cash? Do I get credit? What's my payment going to be like? Well, if you have really good credit, your car payment's going to be low, right? If you have bad credit, you're 20%. We had a client buy a car a week before closing. It was at 20%. And they disqualified themselves, had to sell the car back, and then they lost money so they lost money buying it, they lost money selling it back. Thank goodness they had enough money for closing. But again, those are things that you want to be able to see through all of that and put together the budget and your credit outline. That's what's going to set you up for success. to be able to look at that. Now, I have had experience, but Lourdes, you work with clients day in, day out also.
Mhm.
Have you seen clients use credit repair companies to help them fix credit?
Yes,
And
I
does it help actually?
have. Yeah, so there's some good companies out there, and then there are some companies that literally take your money and it takes months and months and months for it to come back. So really being able to understand how credit works, I think, and getting the knowledge behind how credit actually works, so that you can also, they're not going to do it, or if they do it, they're going to do it on your behalf, or they say, hey, we're going to write to the bureaus to get this off, blah blah blah. So it just depends on your case scenario. So I would definitely run it past the lender and say, hey, is it a good investment to do this, or are there any programs that you can recommend, or can you give me that assistance around that? So those are some of the things. And it's very important for you to understand that any type of, late payments, collections, they don't fall off of your credit until 7 years. And
At least they fall off.
sometimes they don't fall off. So that's an opportunity for you to go and to write to the credit bureaus and say, hey, that needs to come off. It's been more than 7 years and it's affecting me. And once that goes away, then you'll have a better chance. Bankruptcies and judgments can stay on your report for 10 years. So that's another thing. They'll see that and be like, hey, and think about it as a lending institution, like, hey, you have a bankruptcy, or you have, significant amount of late payments. Like, what are you going to be able to pay this loan? And if you don't pay this loan, then they're on the hook for it, and there's all kinds of repercussions. So that's one of the things. David, do you have anything to say about that?
Yeah, I got a lot of things to say about that, but the thing is that uh there's definitely I think there's a lot of companies out there that do wrong to people on the credit piece. They take advantage because they feel that you're vulnerable because you need help. Educating yourself on this process empowers you to be able to do it on your own, right? Again, this is why you want to face the facts. A bankruptcy doesn't disqualify you from a VA loan. 2 years after bankruptcy, you can chapter 7, you can use the VA loan. And guess what? A lot of people that we've helped after 2 years have 700 credit scores. They turn things around. But then there's also people that after a bankruptcy, they go right back into not paying their bills on time. And there's just, you can't help everybody. The message is you have to help yourself because it's your credit, right? You control that. And this is why when you check your credit on a monthly basis and you have credit monitoring, you can see if there's going to be fraud activity.
Yeah.
Then you can catch it. I would talk to people that are like, I haven't checked my credit in years. In years. And then we look, sometimes it's like Russian roulette. It's like, put this, it's like, what's the credit going to be like? But it also at the same time, a lot of people know what their credit, like, hey, this is my credit score. This is what I have. So it's important to know that. And what we're going to wrap up is, what is the credit score to use your VA loan? And the short answer is there is no minimum credit score per the VA. But lenders have these types of requirements, right? So, and it ranges widely. Like for us, we go down to 500. But at that 500, you can't have any lates for the last 12 months on any of your credit, right? Typically, people in the 600 or lower credit score of we found are going to have some type of lates in the last 12 months. And if you're between 600 and 680 or so, it's credit utilization. You're overutilizing your credit. And really a 680 or higher, or sometimes you have a lower score in the beginning because you're building up your credit. Then as time goes on, the credit's going to naturally build. So that 660 is going to turn into an 800 if you just stay on track and pay everything. It will take about 2 years to do. The only credit hacks you can really do is if you add someone as an authorized user. But I'm going to talk about that in a second. There's definitely some cons to all of this, okay? If you don't have a credit score, like you have a zero, the credit pool is pulled and you have no credit, what's going to happen as the lender's going to assign a credit score to you. So we see a lot of lenders assign a 680. They'll say, you know what, zero credit, we're going to assign a 680 credit score, and that's what your rate's going to be based on. And then you're still going to have to provide like, hey, here's 12 months of cell phone payments to show that you can have, so you've actually made some payments on time, right? You got to show that you are, it's not like joining the military where they're like, yeah, we'll take you. Let's go. Let's see what happens. Here, it's like, you got to prove yourself to be able to even get into that. So again, all of that's possible. And a lot of lenders, like I said, have overlays. So Lourdes and I have seen it where a client will get denied by one lender and then get approved by another. We do that all the time, just because we run into nightmares, or clients run into nightmare situations trying to go with the big banks that market to veterans all the time. Stop going to them. There's plenty of better options that are cheaper and you get better service from them, because remember, this is a big investment for you, right? So keep all those things in mind for that. So yeah, there's just too much.
Yeah. Well, can credit change what you qualify for, David? Like maybe change like debt to income ratios or anything like that?
Yeah. So I mean, listen, the more available credit, or the better your score is, the better chances you have of what. I'm not going to get too technical, but there's two ways that really works. When you have really good credit, you can use what's called residual income. And we have other videos on that, right? Basically, it gives you a much higher purchasing power. And if you have lower credit scores, they restrict how much you can get with debt to income ratios. You don't qualify. So now you have to meet both. And the thing is if you're on active duty, they do limit you to 55% DTI plus a residual over. So residual plus a DTI overlay. A lot of veterans don't know that. Military members, so veterans could actually qualify for more than active duty folks, because you're on a fixed income. Like they already, that's how they do it. I wish I had something better to say, but like that's just kind of how it works. So but yeah, thanks again for the questions on this. If you guys have anything, please feel free to reach out to us. There's consultation at the bottom. We can help you with the lending piece, and Lourdes can connect you with an agent anywhere in the country. That's the beauty of what we do, is we help veterans across the country, veterans ourselves, and we just want to give back to the community. So I want to wish everyone a great evening, and we'll talk to you guys soon.